just before 11 o'clock in Honolulu, 4 o'clock in New York. On Friday, happy Aloha Friday as we say on the islands, 6th day of December 2013, and this is the Daily Report for Gold and Silver, our weekend review. Actually kind of quiet as we go into the close. We've had this market really teeter-totter from positive to negative as reactions to the most current job report came out, but currently trading roughly $2 higher on the day, $12.27 and change. The low, $12.11.10, the high, $12.44, and as I said, puts it up roughly $2 on the day. We are looking at a daily chart of silver. This is, of course, spot or cash market, currently trading at 1947. It has had a low of 1917, a high of 1990, and currently trades up between 7 and 9 cents higher on the day. Very interesting day in the precious metals markets, actually in the markets across the board, to say the least, with the release of the latest jobs report. Anticipated number was an addition of about 180,000 new jobs. In essence, it came in at 203,000, little bit above expectation. Major rally in the equities markets as the equities, S&Ps, moved back over that elusive 1,800 mark. Dow Jones, of course, over 1,600. Gold, which initially reacted in the negative, it was bearish for the precious metals because it does show that the economy itself is kind of moving along and it fuels the idea that tapering will begin sooner than later. But initially, we had the market down roughly even 4 or 5, up to $10 lower on the day, and then it started climbing where it was considerably higher, $4, $5, $6 higher. And as we begin to settle, we're looking at a 60-minute chart. You can see that it is settling above 1225. We'll talk about why we believe that is an important price point, but it did, in fact, manage to stay above that line and really recover, which I believe shows us two things. The first thing is there's some resilience in the market. You had some basically bearish news that could have brought the market down and could have continued the downside pressure that we've been witnessing. But the second thing that it tells me, and I think it's a much more important factor, and that is the possibility that the whole idea of the Fed tapering and when they're going to be tapering has at this point really been factored into the market. So news that the Fed's going to begin tapering sooner than later, these are all scenarios which has actually been factored into the current price of gold and silver. And that's really the way that I look at it. But when we look at this particular chart, let's go ahead and compress this a little bit. I have added one fib retracement. The chart that we have been using all week, in essence, began just below 1300 and took us to this low at about 1225. The reason that this had an end point and a start point at these particular price data points is because at the time that we initially put that in, this was the low in the market. The market, of course, came up. This line here, this 1252, is from the new fib retracement, fixing it off of this low. So in essence, when we were looking at these tops here, we were basing them on this 1260. Our stops are currently at 1261. We are short in the market. However, when we add this particular price point, what you'll see is it really lines up quite eloquently with these tops that we've had. And we have some real resistance, I should say, in the market at 1255 to 1261. Our stop is right above that. At the same time, in the same breath, so to speak, take a look at 1225. Of course, we started, as this market came down, pegging this low. But when the market dropped below it, you can see that it was very much a resistive area, and it comes in and makes this new low at 1211 right in here. And then as it comes up, it just steamrolls past this price point. If you look at these hourly bars, look at the size of the bar once it actually broke above this particular former resistance area. So my question has been all week, will this maintain itself, this price point of 1225, as support or resistance? Right now, we're trading pretty much at the line, so we don't really have a clear-cut answer to that. But the fact that the market has recouped and looks like it's going to close above that bodes for the fact that we might be seeing some sort of support come into the market. Yesterday, we spoke about a pattern, which is simply a flat, or also called a truncated fifth wave. We'll explore that a little bit on today's show, and we'll also be including that as we begin to create our forecast and outlook for 2014. We're looking at a 720-minute chart. Now, this is a line on close. I typically don't use this chart except when I want to follow specific either Elliott wave counts or fib retracement points and really take away from any kind of a pattern that we're seeing. The reason for looking at this chart right now, and realize this is the 1181 low, but because it's going off the close, that's why you're getting this higher close here. But really what we want to see is we are getting close to the lows that were created. We had a low of 12.11 over the last couple of days, so we're roughly $30 away from this low. My question that I am pondering is, if we continue to see this market under pressure and it breaks at 1200, will we see some sort of support come into the market? We also are looking at a pattern type that we talked about yesterday, which is really a truncated fifth or a flat. Time permitting, we'll go into some detail on that. But what's going to be critical right now is, first, whether or not this 1225 holds. If it holds, we have various levels to plot on the way up where we're going to find some sort of a resistance. When we look in terms of our current Elliott wave count, the way that we're seeing it is this is that fourth wave right here. And you can kind of see our A, our B, and our C. Now, our fifth wave should be composed of something around 5 waves. It can truncate, it can be 3, but typically it's a 5. And on my best count, I'm still looking at 1, 2, and under the belief that what we have been seeing has been wave 3 of 5, 5 being our intermediate count on our bear count. And in terms of the move above that, meaning you have your intermediate and then you have your major count, we are in wave 1 because we've just clicked into a bear count. Now, as much as there is potential for continued downside action in the precious metals markets, my sense is that we are probably getting close to some sort of a bottom, whether or not it plays out as that truncated fifth, which we'll talk about next, or this, the following scenario, which is a typical what's called zigzag, or basically an extension off of a flat. And typically what you're looking at, this is that long wave 3 down, our wave 4 here. It's my belief that we are currently in 5. Now, 5 can truncate at any point. We've had this tremendously dramatic move here, which is this long wave 3. And when we look at it under this context, what really stands out to me are the series of lows. One, the low that we hit is about 1211, this low being 1181. And if we look at these broad numbers here, and these are based upon 2 fib retracement points, one which really starts at 1050, and the other one which starts below that at 700, right after the market went to 1000 and came back down. 1154, 61% retracement. That's the larger of the 2 retracements. 1249 is the number that we get as a 76% retracement of the shorter of the 2. My sense right now is that really critical support really needs to hold at around the 1181. That's the series of lows that we got right in here. Any break below that, and we've talked about the possibility of it retesting below 1100. I don't think that we're there by any means yet. And I do believe that there is a case that could be made for what's simply called a flat or a truncated fifth, and that looks something like this. Market comes down, and the flats typically come when you have a tremendously long third wave, a standard fourth wave, and what you're going to do is you're going to get a flat or an equal low in both waves 3 and 5. Now, we're looking at a basic image of a bear market truncation. It comes directly from some work of Prechter and Frost from Elliott Wave Principles Key to Market Behavior. And what we're looking at when we look at this kind of a template is you have waves 1, 2, you get this long third wave down. And the third wave down is one of the keys to a truncated fifth because you've gotten such an overextended sell in the market that you tend not to get these new lows. So if we follow this, this is the top of wave 2, beginning of 3. This corresponds, 3 corresponds to this here. Our fourth, as we have identified, was an A, B, C. This is wave 4. And now we're getting wave 5. Now wave 5 will typically unfold as a 5 count. We still could see that. According to my count, I have a 1, a 2. This being our third, we possibly could see a fourth and then a fifth, and then get this matching set of lows with 3 and 5. And basically what happens on a truncated fifth wave is you do not get that new low. It holds the prior low of 3, and then you get a rally off of that particular resolvement or termination, I should say, of wave 5. Now realize this, and this I believe is what's critically important when we consider this current Elliott wave count, and that is when we look at it, we had our ABC, we had our false impulse. It really couldn't make it there, so we had waves 1, 2, 3, 4, and 5. Regardless of whether the market terminates as a flat, if it actually makes a new low, regardless of any of that, we have had for the better part of 2012 and now the better part of 2013, so almost a 2-year period that has been defined as a tremendous downside pressure, especially after our third top. We had our failure. These are these $1,800 marks. The third top cannot take that out, and we get this long wave down. My point to bringing that up is this. Even if we continue in a bear market, in a bear count, once we have terminated this fifth wave, we will go into an A, a B, and a C. In other words, a counter trend rally. I believe that could take us as high as maybe 1,300, 1,350. I'm going to have to do some numbers, but here's where you really run into resistance. And of course, before we ever hit that point, we really need to make it above certain areas. The first one being 1255, the resistance that we've identified. Then there's another one just above, I believe it's 1320 to 1321, and then 1335, of course, is a really important number. But we can see these series of tops here at around 1400. So that would be where I would think, even in a bear count, we could see a substantial rally in the marketplace actually play out. So I'm actually looking at the beginning of 2014, depending on when this fifth wave actually does wash out. When it terminates, I really think we will be entering a period that will be defined by more peaks than valleys, more rallies than sell-offs as we go through this A, B, C cycle. So as I said, I'm not convinced that the flat or truncated fifth is something that's going to play out. We really don't have any evidence of that yet, but it is something that is now in the area that we can begin to consider that as a possibility. More importantly, for us to get bullish in any sense of the way is we've got to break above at some rally this long-standing resistance slope, which has really been a strong indicator. It really told us these last two tops, it gave us a lot of information because it was unable to really take out this long-standing resistance line. So if the market does begin to rally, how it interfaces and interacts here, to me, is going to be a $64,000 answer. It's really going to give us a lot of information we can use, not only the end of this year if it happens now, but the beginning of next. And speaking about next year, you will notice that there are some changes on the website. There's some major changes that I'm planning for the members portal. You'll see those as they come into play over the next couple of weeks. And I do want to let you know that we will be ending the loyalty program. I've extended it to this month, but I will, without a question of a doubt, end that at the end of this year, or at the end of this month, I should say. Now, as far as silver goes, we are seeing for the first time some really mild, but some support at around $19 per ounce. My sense is that if we see a continuation in downside pressure in gold, we'll see silver follow suit, and we will be looking at $18 silver. However, if we get any kind of bounce, we would look at the $19 point as a supportive level. Of course, we are short from well above this, and we'll talk about this next week in terms of our strategy to exit our current short trades in both gold and silver. Now, when we look at the activity of silver standard candlestick chart, we have closed well below what I consider to be an important point, which is 1960 to 1988. It's a 76% retracement level. And unless we find some sort of real support at around 19, and it has to do with these series of tops that we have right here, we don't get any real major support really until we get to about 1825. And that, of course, is based upon this most recent low as the market came from 35 down to 18 and then moved up. This corresponds, of course, to the 1181 in gold. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you next week on Monday for another daily update and review and the next published edition of Chart This. Have a great weekend. Bye-bye.